Blue chip stocks. What are blue chip stocks?
The name blue chip stocks is derived from the colored chips used in poker. In poker, the blue chips have the maximum value attached to them. This terminology has been used to identify the most valued stocks of the stock market. A blue chip stock is the stock of a well-established heavyweight company with good financial performance over the last years. The market capitalization of blue chip stock is generally in billions, and the companies are leader of their respective sectors. Also, they emerge out as a household name. For example, Coca-Cola, TCS, Apple, Amazon, Reliance, etc. For a stock to be considered as a blue chip stock has to fulfill more than just one criterion. The criteria to be fulfilled are large market share, large and established company, highly valued, strong balance sheet, strong financials, pays good dividends, good weightage and index, very popular brand and good amount of mutual fund investment.
What are advantages of investing in blue chip stocks?
The advantages of investing in blue chip stocks are, first, they provide stability, as the blue chip stocks have stable earnings, therefore they offer stable returns. Also, because of their large market capitalization, they fall less than the other stocks. Due to this reason, they are looked as a good investment option during market correction. They also have the power to defy all odds and generate satisfactory returns during market capitalization. Second, they provide good dividends, as the earning of the blue chip stocks is more than the other companies of its respective sector. Therefore, they have more money to pay dividends to its shareholders. The high dividend payment also helps in nullifying the adverse effects of inflation. Third, they have good management. The performance of a company is replica of its management, as it is the role of the management to decide for the company. Their experience and skill helps the company in surviving the crests and troughs of the market. As every company starts from ground zero, the same is applicable with the blue chip companies. With the passage of time, the company grows, and so does the experience of management. The approach of the management plays a very significant role in deciding the future of the company. Fourth, investing in them are less risky, as all the above stated reasons are favorable for good movement of stock, so the blue chip stocks show good movement amidst the volatility of the stock market. They fall less than the other stocks during market correction.
Are there any disadvantages of investing in them?
Yes, there are few. First, they have less growth prospect. A blue chip stock is a very large and stable company, so the scope of expansion in business is very less for such companies. They have a very large portion of the market share. As a result, they cannot expand at a faster rate as the smaller companies of the same sector can. Consider the example of a blue chip stock like TCS and a new upstart software company. The new company has the possibility to increase the sales and profits by 50% and even by 100% or more. But that is not possible for TCS, since the company already has large number of customers around the world. Second, they give less return, since the company has less and limited scope of expansion, so the increase in profits is also limited. And as the stock movement is the interpretation of the financial performance of a company, so the movement of the stock becomes restricted.
Should I invest in them?
As the blue chip stocks offer less return and could never turn out to be multi-baggers. The question that arises is, should we buy blue chip stocks then? The answer is undoubtedly yes, but the investors can play with a percentage of blue chip stocks present in their portfolio. Why should you not buy stock of a company which definitely will yield more return than normal bank FDS? The percentage of blue chip stocks in one's portfolio should depend on age, as the young age investors have usually less responsibilities to deliver as compared to a middle-aged investor. The same is applicable while comparing the middle-aged investors with the old-aged investors. Also, the young age investors should not become too aggressive, as they do not have the experience and in-depth knowledge of the market. All should have a minimum of 30% blue chip stocks in their portfolio. This percentage will surely benefit them during the market bleeding of market. Thanks for clarifying my doubts.